Welcome, everybody. Thanks very much for joining us. I'm Sharon Constanson. I am Chief Executive of Value Fund and Constanson Currencies, and we're going to be sharing over a four-part series with you some of those key nuggets of how to manage your foreign exchange that you would not learn in any professional environment. I have with me my guest, Eddie Rawl, who's with us for this entire four-part series, who's a key individual and franchise holder for Best Forex in South Africa. So, Eddie, welcome very much. Thanks for joining us. Right, the topic of four series is four webinars is covering Forex risk management. What are the typical actions that cause risk and often cause a lot of cost to businesses? The areas in foreign exchange risk management where people think that they're doing something extremely effectively, but actually there's a vast degree of misunderstanding and therefore costs and time and risk that is materializing. And then we would like to talk a bit about our foreign exchange risk management function, how that works within a company. And then we will be looking at some real life case studies in each of our sessions. Today, we're going to be looking at the policies, operations, the business part of foreign exchange risk management. Probably described as the most boring part of it, but actually highly critical, because if we don't know where we're starting from, this is going to be a situation where we are therefore creating even more risk. When I first started Constanson Currencies back in the late 80s, I did that because I had worked in a corporate doing foreign exchange risk management, assuming that my bank was able to understand and know what I needed. When I went to go and work for International Bank of Johannesburg and now sit on the other side of the fence talking to customers, I realized that customers are multi-banked and not able to therefore share certain information with me, but often didn't know what information to share with me or where to go and find it. So in 1989, we started up Constanson Currencies, which pulled together the ability to do both of those sides of the equation for the benefit of proper risk management. So this exposure part of it is highly critical. And really, you do need something a bit more than an Excel spreadsheet, hopefully, to get your to grips with the foreign exchange exposure. So either order systems, accounting systems, or systems like foreign exchange risk management, FRM, that we run as well. There are a number of other systems available globally that can do it, but most of them are systems that are geared towards holding the data for the banking information, the foreign exchange deal, the trades, the exposures, the trades that are being taken out, rather than the situation of being able to track what the actual risk is in the first place. So please be mindful that this is an important area where there's a lot of data that you need to capture. So Eddie, maybe we can talk a little bit about this area of exposure management. Both you and I were sharing a few war stories just before we started today of the kinds of things that we see companies doing. And maybe you could share with us what are the broader things we need to make sure of, just at a high level point of view, just to begin, around those exposures that we need to be mindful of.
Yes, thank you very much for having me on this webinar. I think number one, if you don't know what your exposure is, and if you don't know at what level, and when I say level, what exchange rate you're in at, then you don't know what you're managing. And that is, to me, that's the most important part, is to cost your exposure correctly, because that is quite often done incorrectly. And the end results is then, well, it could be disastrous.
And from the point that you're raising now, it's very critical that a company needs to know what their accounting cost is, but we also need to understand what our real cost is once we get to that point of hedging or not hedging. One of the things that I have found in my years of working with organizations is that we sit with the circumstance that new orders come through the system. Talking to somebody in this market actually just last week, where a lot of the orders that come through a department in their organization that don't share it with finance. It's a sales department. So the sales department don't tell finance that they've just had an order placed for something that has to go through a manufacturing process before it can be exported to the customer. What would be your advice to hearing that information from an organization as to the risk they've got of not actually knowing what their outstanding orders are in the finance department? They know in the business somewhere, but not in the right place.
Yeah, that is a very typical issue. And I've, in the past, at clients where I've been asked to put a policy in place where exactly the same thing was happening. I said, but you know what? Just walk across there 5 times a day and say, have you got new orders? And ultimately, the message gets through, and then the stuff gets transferred to the right or communicated to the right people. Without that, you're dead in the water.
Absolutely. And if you don't know what your exposure is and how long it's for, I think this is the other thing that I find quite interesting in a business is some companies will sit with a order lead time of 18 months. I've worked for an organization that was in the retail fashion industry, and they were bringing in product manufactured in China based on the retail world of fashion. So therefore, they were designing it a year before that. So we had 18 to 24 month cycle. I have another customer that we work with that sits at the moment that it's order, manufactured, shipped within 3 weeks from order, and then is paid within 7 days of the ship departing an offshore environment. So the kind of risks that you've got in those two businesses is dramatically different, particularly as an importer in South Africa, where we have a very high premium to pay. Would you advise the company that is sitting with an 18-month window and a company that is sitting with a probably 4 to 6 week window differently? What are the sort of things you might discuss with them as to that risk profiling?
I mean, you have to look at the two things differently. 18 months, you cannot hedge in most cases, but you need to make sure that you're going to be able to transfer or pass the increases if necessary or whatever. You need to pass through. If you can't pass it through, then you have a problem. Then you need to look at hedging it. But hedging that kind of far out is just way too expensive, and you're going to price yourself out of the market. But definitely, you need to look at the term of your payments. Simple.
It's very, very critical. One of the things that I have noticed for companies that they equally don't manage very well is the flow of information that something is now no longer an order. It is actually now an asset or liability. The goods have been shipped, risk has transferred in whatever mechanism it occurs in different organizations, and now we're into the credit period starting. And that can be anything between 1 day and 3 to 5 months. Depending on the nature of the industry and the credit terms that organizations have negotiated. How would you advise a company to manage the knowledge and the data between what is sitting in orders somewhere in the system and what is now sitting invariably has been raised into the accounting system?
Sharon, that's a very difficult one because it really depends on when the company recognizes the exposure at order date or at invoice date. Now, some people, or a lot of companies recognize it at order date and others only at invoice date. I think if you recognize it at invoice date, you're a little bit too late because you've already gotten exposure when the order has been placed, unless the order gets cancelled, but that rarely happens actually. So if you do everything from order date, I think you're already in a better situation.
It'd definitely be in a far sounder Forex balance position where you at least have evened out your risk as things are moving up and down all the time. One thing we also notice, and it's something I discussed with a customer very recently, is that it is unknown what the quantity will be on the pallet that finally leaves. So when they export the product, they think they're going to export N units. and it's N-1 or N+1 or whatever. So the unit number differs. And they are sitting with the fact that they have taken cover. They expect to receive 100,000 and receive only 98,000. What are the different options that an organization has? One, to manage that constant variation of the underlying information that is occurring, and therefore that changed volume of shipments, and therefore the impact that has on their immediate exposure they have at that moment.
I think in this foreign exchange game, it's communication. That is just vitally important. As I said to people before, walk down or up and get the information, but you need the information. Without the information, you're dead in the water. And you know, I mean, this thing happens all the time where orders change. It's just, you need the communication, or you're not going to be able to manage your risk appropriately.
Which comes back to data management, a mechanism, one to know that something's changed, another one to record that something has changed as well. And also then to look at the bigger picture. We work with a customer who's got very distinct seasons. You might find this in agriculture, you might find it in fashion, you might find it in production cycles, also things where things happen for 3 months or they happen for 6 months, and then the rest of the year is quiet, and how they should manage those intense periods of Forex risk versus their less intense periods of Forex risk. I'm going to move now to policy. This is the one that amuses me, frightens me the most, because people will use policy to lock down or remove, address risk. But actually, in a lot of occasions, they are not achieving that. Is there some stories or some examples of where you can share with us where policy has actually created a problem?
Yeah, I think, you know, I've had to do a policy for a very large corporate some time ago. And I said, okay, how much are you prepared to lose? And he said, well, we're prepared to lose this much. And then I applied that loss to his current exposure. I said, well, this means if the rand moves 2 cents, you're dead. You have to cut your position. No, but I can't. And that is typically, the policy does not reflect the size of the position, or his position is way too big. But that's a classic case where the two don't talk to each other.
I have a circumstance where I came across a policy of being 100% covered on imports and 0% covered on exports, with no definition of when in the timeline that was to occur. And they thought they were protected, which I see you smile.
I've also seen that a lot of times, and they're doubling the risk.
Mm-hmm, exactly. Thank you for that. And I think they were looking at me incredulous, saying, doubling my risk? Why would I be doubling my risk? Absolutely, you would be. The things that companies need to consider when they're looking at policy are things around the risk appetite. Could you give us some things that they need to look at within the greater risk appetite that is important to support them? Along the story you gave a moment ago, is what is their risk appetite for loss or for change or for volume changes, things like that. Give us some insights, please.
Yeah, I think the company must have a look at what kind of loss they can absorb as a company before they start putting pressure on the business itself. Without that number, you don't really know how much you can lose. And obviously you don't want to lose the maximum that you can lose, but you need to, that needs to be part of your policy, because you need to be able to set limits on your exposure so that you can see when you're getting, and you need to measure it every day. What is my exposure now? What happens to it if I cut it now? In order to see how far you are from that loss level. And stop loss levels are not negotiable. I mean, it's if it's set in the policy, that's it. You need to take your position out.
That's where in a policy talking about ratios rather than physical sense or exact prices is a lot more meaningful within which the Treasury Manager can operate. Another thing we also suggest is that the policy doesn't demand a single decision per year, per season as well, and that they can work with ratios of cover over ratios of time horizons, so that they are always in a position that they can take full opportunity, but equally have the degree of risk protected. You'll often find, and I'm sure you've seen this as well, where the board risk appetite is far lower than an individual's risk appetite. When you get people together, they go to the lowest common denominator. Have you seen this happen before as well?
Oh, yeah, absolutely. Where the MD was running massive risk. And I said to him, so what happens if this goes wrong? Is your board going to be happy with this, or are you going to lose your job? And he actually got quite a fright, because he realized that the exposure he was running was not board approved.
Interesting. Also the thing that we notice on risk appetite is the more educated people become on the reality of foreign exchange risk, not on their perceived understanding of how Forex works, we find then the ability to make balanced judged decisions around foreign exchange is far more feasible. How do you think the product, the seasons, the customer, the pricing, the currency, all can influence the way a policy might be written?
Well, I think if you look at product, for instance, you not only need to look at the costing of your own product, you also need to look at who your competition is in the market and where are they sourcing their product from. If they're sourcing their product, I've had the case where my client was sourcing from Japan and his competition was sourcing from the US, and the dollar yen started changing, and my customer found himself in a position where he had problems competing because it was cheaper to import in dollars. So yes, there's massive influence, and you need to look at all those and take them into account.
It does make a difference. Also, if they work on a catalog season price that they can't change, for example, or if they were to change the price, they would lose competitive edge and lose a share of the market. So it's trying to work out, do you take a loss leader or do you lose actual turnover? So that'll depend on production cycles, salaries, fixed costs. It becomes now, and I think the important part I'm trying to make here, which you've alluded to as well, is foreign exchange is an integrated business decision. It's not something that you can take that stands alone on its own. We've talked about some of the mistakes that exist with the policy. Another mistake that we often see happening is, oh, it's a year end on, let's say, 31st of December. And they tend to focus their entire Forex life on that year end. What are they going to have to show in the accounts? What are the potential revaluation mark-to-market situations that might occur? And that sort of unknown number, which it will be until that moment, causes businesses to make some very strange hedging decisions and risk decisions. Have you got some that you may share with us?
Yeah, I've seen that a couple of times where, I mean, even going so far as doing an option, way out the money, just to transfer profit from the one financial year to another. Look, it worked for them, but it's one of those things. It's a going concern, and you're going to have to deal with the P&L and the reporting at year end, and you can explain it in your notes, to your financial statements.
Interesting. Working with a number of customers, we see the circumstance of almost that they behave as though the business comes to an end as the the financial year ends, and they desire to be in a zero covered position at year end. Policy is something completely different, bear in mind. And then when they start the new year, they say, well, we have to be 75% covered or 50% covered or whatever the percentage might be. And there's 1 hour, 1 minute that occurs between the one moment and the next moment. So it causes people to make some very strange decisions. And we've often seen over the 40 years I've been in the market, I'm sure you've seen it, how often in the second week, third week, fourth week of January, we see a high degree of volatility in the Rand market, for example, because everyone's now come back from a year in, from leave, and the market's somewhere, and they make a year's worth of decisions in one moment in time. Banks love it, profit moment for them, but it isn't necessarily a single decision that is appropriate. And we do see enough volume of that happening to actually move the market, even though the market's volumes are far higher in speculation and interbank trade than they are for actual physical trade. But given that we need to move on from a time perspective, the kinds of things that we see occurring in the market is people say, I just need to do what the policy says. I don't use my brain. I just need to beat the accounting rate. I ignore opportunity. Have you seen this happening? And what's wrong with that?
I think what's wrong with it is obviously that you're not maximizing your opportunities, which part of risk management is not just reducing the risk, it's also trying to improve the situation for the company. Because if you can improve the situation and improve your costing on your product, that means you can start outpricing your competitors. So you can't just follow something without putting some intellectual or rather thinking about it. Yeah, you need to analyze and think about it quite a lot. You can't just, as you say, blindly follow a policy. But a policy shouldn't, in any event, give you more, space to maneuver. It shouldn't be 75% covered at all times or whatever.
Whatever it is, yes. And of course, with the underlying moving and having the black swan, flock of black swans that we've had in the last 2 years, you'd be 75% covered for a lot of businesses that either couldn't ship because the ships were all in the wrong place, the product is not required because people are working differently, or Russia, we're not shipping there or buying from them anymore. Companies have ended up with massive changes in the underlying exposure, and therefore not having a degree of intellectual approach to the business as well as policy and exposure, you're going to end up in more and a greater risk overall, very, very, very easily. You talked about opportunity management. I align that to, if I can buy stainless steel better, or if I can put a higher quality fertilizer in, but at the same cost, I'm going to grow a better product. If I can drop my price by 1 cent and get a higher turnover, these are all business decisions that are exactly along the line of what you talked about, of taking full opportunity whenever it is available. It's not now dabbling in currencies, which is what the other half of the equation is. Oh, you're taking risk because you're dabbling in currencies. No, we're managing something that is not creating risk. If anything, it's reducing risk in every respect possible. There are various decision points in which things happen in the foreign exchange life of a treasury manager and a treasury department, and things that we've talked about now, but I can't, due to time, we can't go into a lot of detail around this. But there's, at what points do I phone a bank or interact with my policy, interact with my exposures, or interact with my hedging portfolio to make sure that I am looking after it? So my answer to that is every day. That's the first answer. But that is always not feasible. If you're running this as an additional portfolio to the finance director or the financial manager or the debtors clerk or shipping clerk or sales people. So it's making sure that there is enough time and capacity to get to the point of when you're going to be making these decisions. So you need to then look at, when am I going to make my varied set of decisions? How am I going to place those? And making sure that we interact into the marketplace, under our control, not under our reaction. And also, when you get to payments or receipts happening, that is an immediate moment for us to look at our portfolio, look at opportunity at that moment in time, and see whether any is being afforded to us. I'd like to thank many of you who've been putting some questions into the Q&A function. Thank you very much for that. One of the things that was highlighted, and this applies very much in the South African environment, is exchange control. You have certain risks that are placed on you of tenure or of volume or of open positions that the exchange control environment does place. And it's very critical, absolutely, that the Treasury Manager is fully aware of what those are. And they're not static. They do change from year to year quite often. And sometimes they are, to the point made by the individual, sometimes you cannot hedge some of your risk. You're not in a exchange control position to do it. So policy, behavior, reporting needs to cater for that bucket of activity that falls into a different risk profile, so that you don't muddy the overall information that you might be looking at a board or a Treasury Committee level. There's the comment around natural hedging. We'll cover this probably in a lot more detail in the next session, but a natural hedge only exists if you have the exact same amount on the exact same day. It arose on the same day and it gets delivered on the same day in a currency, and neither of the underlying change. Okay, we all know that's not realistic. So natural hedging is not natural. We had a situation for a client the other day who had a euro sterling situation where they had a positive and a negative, thought they had a natural hedge, but they have anything but up to 2 months time difference between the two. So you can create the natural hedge through the swap market. You can then treat that part that is naturally hedged, because it was only a part, at the same rate, but you have to deal that transaction at that moment in time that you wish to secure the natural hedge, leaving the rest of that open. So you also have the issues around head office treasuries and all those complexities, which we're going to cover in a future session as well. And the other aspect, which Eddie, you did cover, so I'm not going to place the question, but just to summarize, what your competitors are doing, their currencies, your portfolio, your customers' expectations, all of those things come into understanding what is the best policy for you that protects your business, but equally is mindful, but is not reacting to competitor activity. So a summary is up on the screen. I'm not going to go through that, but it's making sure you know what your exposure is. And at all points in time, you own that information. You own the timing of taking decisions, and that you are mindful that delegating things to junior levels create in themselves risks of things not being done in a time frame you might be at a senior level perceiving, and in reality that's not actually how the paper flows within the organization. So we do see a lot of those kind of situations arising. So I'd like to thank everyone who's attended to our short nugget around exposures and policy today, and we'll pick up with that again on the 29th. We'll be covering the next stage of the foreign exchange hedging instruments and accounting, which are the two other sessions that are to follow on this area of Forex risk management, and areas that most education available to us, university, online, professional, don't actually get to the detail that we're trying to talk about today. So if anybody would like to contact Eddie at Best Forex or myself at ValueFin or Constanza Currencies, please feel free to do so. Both of us are on LinkedIn, and with our unusual names are easily found on LinkedIn. So please do make contact, and thank you very much for attending. All the best, and we see you next week.